Today, I'm going to discuss to you the power of dividends, how it plays a big role in the overall returns of your portfolio, and how you can become financially free by tapping in the power of compounding interest through dividends. As said by Albert Einstein himself, compounding is the eighth wonder of the world. He who understands it earns it, and he who doesn't will pay for it. So let's see how dividends is one of the ultimate way to use this wonder. Let's start. If you are investing in the stock market, we all know we get two types of income from it, which is capital gains and from dividends. So with this two, you can let compounding work for you. In capital gains, it's when you sell a stock and reinvest it back again to another stock. Assuming the stock you sold gained interest for you. And for dividends, the same. A company gives out dividends every year and you can reinvest those back to that company or another company that you like, wherein that will make you more money the next year because the dividends you reinvested is earning dividends as well. Now, it really stings me in the ear when I hear people say dividends aren't worth it. Dividends is such a small percentage. How can it bring wealth to you and even reach financial freedom with it? So how powerful are dividends anyway? Well, before that, I would really appreciate it if you click on that like button first. That is a powerful force for the YouTube algorithm. Going back to the topic, the power of dividends. Now let's use first the PSE index with an overall dividend yield at 1.90%. So quite small, right? Well, it would really look small for you if you look at it that way alone. Dividends becomes more powerful over time when you reinvest it over and over again. As it compounds, this gives you more dividends along the years. This is what we call a snowball effect. As it rolls down the hill, it gets larger and larger. Same for dividends. Let's look at the data here. Let's just say you always get a 1.90% dividend yield as you invest along the years. So for example, you have 1 million peso and just leave it there and have an automatic reinvestment plan. So in 20 years time, your money would have accumulated 448,551 peso worth of dividends. And after taxes, which is 10% here in our country, you now have a total of 1,380,096. Imagine with just 1.90% dividend yield, and as the years goes by, your dividend yield also increased because you kept on reinvesting it back again and again, ending with a 2.67% dividend yield based on your invested capital at year 20. And again, this is only dividend gains alone. This is the power of compounding. Imagine earning 448,551 peso in 20 years time without doing anything. Now, what if you take it to the next level? You didn't just invest in an index fund. You invested in individual stocks that pay out a minimum of 3.5%. Let's just say your whole portfolio has a dividend yield of 4%. So in 20 years time, your money would have grown to 1.9 million and your dividend yield by then would climb up to 8.11%. Imagine in your 20th year, your dividend yield is now 8.1%. Again, this is only dividend gains alone. And this is just with 4% yield. Some companies raise their dividends as well along the years, especially when they have good years of earnings. Now let's have a real life example. So let's look at Warren Buffett's Coke investment. Now he invested in Coke way back in 1988 with $1.29 billion. And Coke is one of the best dividend companies out there. They had been increasing their dividends yearly. And Warren Buffett just held on to that investment up until now. And you know over time how much dividends Warren Buffett makes? Well, from what we've seen a while ago, your 4% dividend yield climbed up to 8.11% after 20 years. Well, for Warren Buffett, it's a monstrous change. He now gets an astonishing 52% dividend yield annually. That huge. Imagine in 2021, he got $672 million worth of dividends from his initial $1.29 billion investment. So he gets his money back every 2 years, and Warren Buffett reinvested all of the dividends he got from Coke to other companies. You see the power of dividends when it is given the time to grow. Snowball effect at its finest. Now there's a study that was made how much dividends play a part in the overall returns of the market. This study was done in the US for their S&P 500 index. So this was grouped in decades. As you can see, there are some decades that dividends took the larger role in the overall gains of the market, like in the 1940s, having a 67% contribution, and in the 1970s, having a 73% contribution. Now, this sometimes happens when the whole market is trading sideways. it just stays stagnant for quite some time, and this usually happens in the Philippine market. If you look at 2015 onwards, before the crash of 2020, the market didn't gain much, and the same in 1993 up to 2003. Market even returned negative, so just imagine how dividends played a big role during those times. Going back, if we tally all the years from 1930 to 2020, dividends had 41% participation in the overall return of the S&P 500. Imagine, 41%, almost half of the overall returns. Now, what if you didn't reinvest the dividends? Like for example, every time you get a dividend, you withdraw it from your account and spend it, like a lot of people do. Well, your returns would be cut down big time. Looking at this chart from January of 1977 up to December 2020, this is with a $10,000 investment. With dividend reinvested, your money from $10,000 would have grown to $638,471. But if you didn't reinvest those dividends, you only get $172,351. Imagine that huge of a difference. Why? Because even though dividends may look small at the start of your investing career, it would compound and compound along the years. Well, let's not mention this chart with a longer time period. This one from 1960 to 2020. Imagine 3.8 million if you reinvested every dividends compared to 627,000 from a 10,000 investment. Once again, the power of dividends and compounding. Now sadly, there isn't a study in our country about this comparison, but it's still the same. Whenever you don't reinvest dividends, your gains would really be cut down. Now I would also share to you a strategy revolving dividend investing, and this is also the one that inspired me to have a dividend value approach in my investing journey. This is taken from the book What Works on Wall Street by James O'Shaughnessy. This strategy is called the Dogs of the Dow. Now, Dow Jones is an index in the US. The main goal of the Dogs of the Dow is to make things easier for investors. They just invest primarily in the 10 highest dividend-paying Dow stock. So they do this every end of the year. And this was done from the 1930s up to 2000. So if we look at this chart, almost every decade, the Dogs of the Dow outperformed the index. The exemption was only in the 1990s when they underperformed by just a tiny fraction from the S&P 500. With this, if an investor invested with this strategy from the 1930s up to 2000 with $10,000, their money would have grown to $57 million. That's a compounded return of 12.24% compared to the S&P 500 at the same time frame had only a compounded return of 9.70%, making that 10,000 investment to 10 million. Imagine a simple strategy. They just invest in the highest dividend paying company in the index, so they are still investing in a blue chip stock. Take note, and it beat the market returns by a landslide. And one of the best part of dividend investing is you don't have to sell to make money, because usually companies give it every year and it goes directly to your brokerage account. Passive income in an instant. You are making money without doing anything. With this, better think first before underestimating the power of dividends. It may look small now, but let it mature. Give it time to compound and compound along the years. And I tell you, it will one day surpass the money you are investing monthly. Your dividends will one day be bigger than the one you can invest and even more than your salary. Just give it time. Reinvest it over and over again. This is the best thing you can tap in the power of compounding. And like what I've said, you don't have to sell your stocks to gain money. This is passive income at its finest. If the dividends you get is now more than what you are spending, you are literally financially free. You can survive your whole life and you don't have to do anything, then just sit there and wait for the dividends of the company to arrive in your brokerage account. And just imagine, if you invested in a great company that pays out dividends, you get a raise every year. So to wrap things up, don't use those dividends for your vacation or to buy yourself a new phone. Let it grow first. A lot of people often have the mentality when they earn more, they can spend more. Well, of course, you can spend more, but the thing is, if you spend it all, how can you tap in the power of compounding even more, especially with the dividends you get? So please, do not underestimate dividends reinvesting. You've seen the graph. You've seen the different research a while ago, how it will cut your overall returns in the future. Remember, tap in the power of compounding as much as possible and as early as possible. Let it snowball. And again, he who understands it earns it, and he who doesn't will pay for it. With that, I hope you liked the video. And if you do, and haven't clicked that like button yet, now is the time to do so. And please, if you still haven't subscribed yet, Now's the time, hit that subscribe button as well. And if you want to further study the articles I've shown a while ago, all of the links are in the description below. So again, thank you and see you in the next video.